basically have given back last 3 weeks worth of gains with what we've seen over the last 4 sessions now. Ajay Vora is with us, Head of Equities at Nuvama Asset Management. Ajay, good to have you here. Thanks for your time. I'm sure you're someone who follows flows and the color pretty closely in terms of what's going on out there. So tell us what's going on. Pretty much everyone we've spoken to, we've asked the flows question, and generally, if I can paraphrase, without being too offside, it's that maybe in the very near term, a lot of the money which is leaving perhaps is being used to fund exposure to China, but it's like a week, fortnight thing. So with that preface to my question, tell us what you're picking up.
Sure. So good afternoon, Prashant, and thanks for having me on the show. So I think the bottom line, Prashant, is that markets are lacking any positive triggers. If you look at it, before the Fed cut the rates on 18 January, our markets were somewhere close to 25,000 odd, and everyone was trapped into that rate cut, on both the sides. So if you look at the positioning, HNIs were heavily short on index, and FIs were also not fully deployed as such, I would say. And that move led to FI increasing their longs, and eventually HNIs had to cut the short. So broadly, we got around 5 to 6% kind of a move post the rate cut, and now over last maybe 3 to 4 days, that has just got negated, right? So we are back to 25,000 odd levels. The point is that we are lacking fundamental positive triggers right now. And on top of it, you have two major, I would say, variable events which has come to the surface. One is on the geopolitical side, and secondly, the whole China angle. So, whenever the markets lack triggers, something of this sort comes to surface, it will result in a lot of uncertainty. The way I look at it, this is a really healthy period for the markets, I think, because if you look at it, since April till now, our markets are up close to 15% odd. And we are seeing, a decent earnings cut last quarter as well as this quarter. So my point is that, if the overall earnings growth, which was expected to be, say, 15, 16% earlier, I think we'll end the year somewhere close to 10% odd. And versus that, we have a market which is already up 15% for the year. So I think it's important to consolidate here with some sort of, correction, more correction over next maybe couple of months. But I think that will be really healthy. Just to gauge, where exactly now the next trigger will come in terms of the sector allocation, and basis that, we'll see performance going forward. But I think this is a healthy correction. The China angle is definitely playing out, and that can continue. But that doesn't take away the earnings growth trajectory for India. So that's how we look at things.
So you're saying the earnings growth for FY25 is just going to be 10% versus estimates of 15-16% at the beginning of the year?
Yeah, so actually, if you look at it, Rima, last year we have ended at somewhere close to 980 odd. We started the year with somewhere close to 1130, 1140. That number is already down to, I think, 1090 or 1100. So broadly, we are looking at 10-11% now versus 14-15% earlier.
And how much will that hurt? Now, we've already seen about a 5% correction from the top. Now, in the last, 1 or 2 years, we haven't seen even a 5% correction, or at best, it's been a 5% correction before a bounce back takes place. So if in the Q2 earnings, we continue to see some downgrades, do you expect downside in the market?
So I think it's important for us to change our habits also regularly. We should not get used to not seeing a 5% correction also in the market. So my sense is that, the whole sector rotation will continue. We saw, auto and pharma being the best of the sectors last year. And the earnings is still pretty strong, but the valuations doesn't leave enough room for upside. On the other hand, I think that, if the rate cut cycle continues in US, and that too on the aggressive side, I think the IT as a sector will continue to see some sort of, order book building up, which will result in higher visibility of growth. So I think that, IT and on the other hand, metals, these two sectors are really well positioned from here on. Domestically, if you look at it, I would say banking is still a bit on the struggling side, because, on the unsecured loans, we are going a little slow. On the NIM improvement also, we are going a little slow. So I think that the banking, which is a very large sector, will have this overhang going forward. As I said, auto, pharma, they are more or less getting done, and therefore we need to look for different sectors which can take leadership. So markets can stay in a range, but as money managers, it is important for us to identify the next big opportunity.
Ajay, hi. Afternoon. You're the second guest today who's pointed out a sense of complacency. In the morning, you were in conversation with Alexander Redman of CLSA. That's exactly the point that he was making, that the Indian market perhaps is getting a little complacent. It reminds me of a dialogue from an OTT serial which played a couple of years back, and that dialogue went in Hindi कि अपन को लगता है कि हम ही भगवान है, right? So I guess it tends to happen. That's what bull markets do to you.
Like small, not hum, apun. What is it?
अपन को लगता है मैं ही भगवान है. If I could, I'm taking the liberty because it's a Friday, right? Eventually we'll go back and have a good weekend. So exactly, I think everybody's guessed which particular series this was. But yeah, I think that's what bull markets do to you, right? Because the whole valuation chatter was being cast aside because prices were moving higher, because liquidity was so heady. So therefore, your point is well taken, though the bulls may not actually like it right now. Okay, let's talk about Q2. You gave us the earnings projection for the full year, but the here and now, because we're running into the season and the litmus test is upon us. The board exams are here. Where do you see the biggest, perhaps, pain points? What should we be prepared for, where probably there would be a disappointment, and maybe earnings projections will have to be revised downwards, and maybe stock prices will need to move down as well in Q2?
So I think that, still on the growth side, IT will see, the numbers to be muted. But the point is that, that whole narrative is behind us, and people are more looking towards the incremental growth or the expectations of further order book buildup going forward. So I think that more than numbers, the focus will be on how the TCV actually shapes up over next 2 to 3 quarters. On auto, also actually, if you see that, this is the start of the festive season, and we will see some sort of inventory buildup, and therefore the numbers have been good. Raw material prices were a bit lower, and therefore the margins will also continue to remain good on that particular front. But I think that overall, if you look at it, a major disappointment last quarter, which was from OMCs, oil marketing companies, that will not continue in the current quarter because of the healthy marketing margins which they made in this quarter. So my sense is that overall you will not get a major disappointment anywhere. But the point is that the 13, 14, 15% expectation is slightly getting pruned quarter after quarter. And once market digests that this year it's not going to be double digit and it can be maybe 9-10%, we can see some sort of further pullback on the markets. So I think no major negative surprise as such is what we are building.
All right, fair enough. Ajay, we'll leave it there. Thank you very much for joining us, and good perspective as always. Have a good weekend, and we'll come back next week maybe with better tidings, better news, and better markets as well. But for now, we're down a little over 1% actually.